Now, while equity markets in the financial industry assimilate the surprise move by Bank Negara Malaysia to cut its lending rate, research houses are already of the opinion that the rates are in for a further reduction, but all for a good reason.
The central bank's aim is primarily to sustain Malaysia's economic growth, which has been forecast to grow between 4 and 4.5% this year. Hong Leong Bank opined that the central bank was taking a preemptive measures to vary the risks and repercussions arising from Britain's exit or Brexit referendum. Yesterday, at the end of the two-day monetary policy meeting, BNM announced a 25 basis points cut in the overnight policy rate to 3%, the first since 2009, to ensure the economy remained on a steady growth path. From April 2006, the OPR was hovering at a high of 3.50% until October 2008 and dipped to a low of 2% in February 2009 and continued to rise gradually thereafter to 3.25% before yesterday's cut. Hong Leong Bank acknowledged that the monetary policy statement by BNM suggested that the next course of action would largely depend on upcoming economic indicators, in addition to monetary and financial conditions. Recognizing downside risks to domestic growth arising from both domestic uncertainties and external headwinds, Hong Leong Bank opines further policy easing is possible. In addition, the diminishing U.S. Federal Reserve rate hike outlook would also offer more room for BNM to nudge rates lower. It said the global and domestic growth prospects are already fragile, confronted by mounting headwinds, the outcome of the EU referendum in the last straw that broke the camel's back in its view. It noted that BNM has toned down its assessment on the domestic economic outlook. The bank added that uncertainties in the global environment could weigh on Malaysia's growth prospects. The monetary policy meeting will continue to monitor and assess the balance of risks surrounding the outlook for domestic growth and inflation. FXTM Vice President for Corporate Development and Market Research, Jameel Ahmad, said by cutting rates, the central bank is trying to entice further domestic borrowings in the hope of lifting growth prospects at a time when the global economic environment itself remains uncertain. He noted that local equity markets were likely to trade higher following the news because the stimulus measures were seen as a positive attempt to encourage growth, and this is generally how equity markets react globally. Ahmad said the Malaysian Ringgit appears to have gained slightly in the aftermath of the decision. However, he said this is probably attributable to the increased risk appetite seen across global markets as concerns over the outcome of the EU referendum begins to subside into the backdrop. At 5 p.m. today, the ringgit hit a 10-week high versus the US dollar at 3.9450 from 3.9690 on Wednesday.